Hey everyone, and welcome back to the channel. So if you're someone that's looking to buy their first home and want to save the most money possible, you came to the right video. If you're new here, my name's Enrique. I'm a mortgage broker based in Southern California. And in today's video, I thought it'd be interesting to share with you guys some of the secrets on how to save thousands and thousands of dollars on your first home without any crazy programs, without any crazy requirements, simple things that you can do on practically any home purchase. And believe it or not, most first-time home buyers don't know about these. So make sure you stay to the end of this video and also share this with your friends if they're looking to buy their first home. So without further ado, let's get started. All right, number one are seller credits. A seller credit is when a seller agrees to pay for a portion or all of your closing costs. Now, in order to understand that, let's go over what are closing costs. Well, when you're buying a home, there's two parts of your cash to close or the total amount of money you'll need to purchase your first home. The first part, which is the most commonly known, is your down payment, right? If you're putting 3, 5, 20% down. The second half are your closing costs. These are things like your taxes, your insurance, the paperwork fees, etc. So these seller credits can go toward paying some of those closing costs because those closing costs will be anywhere from 3 to 4% of the purchase price. So let's say it's a $600,000 home. 3% of that would be roughly $18,000. So it is a good lump sum of money. And if a seller can pay for a portion or all of these, it's great news for you. On top of that, it's also very important to know how much you're able to actually receive because every loan program has a limit on how many seller credits you can actually receive from the seller. For instance, with a conventional loan, if you're putting less than 10% down, you're allowed 3% of the purchase price in seller credits. For FHA, it's 6%, so it's a lot higher. And then for VA, it's about 4%. For any non-QM programs like bank statement, ITIN, it's usually around 6%. So it's very important that when you do get pre-approved, you ask your loan officer, hey, what's the maximum amount of seller credits that I can receive per my loan program? All right, so now that you guys have an understanding of seller credits, let's go over the 3 strategies for this tip. And by the way, all these strategies do require that you work with a very, very good real estate agent because they're essentially the ones that are going to negotiate these seller credits for you. And this is why this is actually an extra bonus. You need to work with a great real estate agent. Because if you're just going with someone that's your friend, they're possibly not going to have the skill or the negotiating power to get you these seller credits. So that's very important. All right, so strategy number 1 is going to be to ask for these on your contract. So as part of your contract, your agent will put, hey, we want $5,000 in seller credits or $10,000 in seller credits that my client can use for their closing costs, which is yourself, right? That's the first strategy. The second strategy is to actually finance these seller credits into the purchase price. Now, the thing here is that the property does have to appraise. Let me explain. So let's say someone's selling a home for $600,000 and you're like, hey, we'll give you $620,000, but we want $20,000 in seller credits. So you can see that you're essentially financing your seller credits into the purchase price of the home, which allows you to come in with less $20,000 on the cash to close, right? Now, this is only possible if the home actually appraises for $620,000. So for this strategy, you want to consult your real estate agent. Hey, do you think it'll actually appraise for what we're offering the seller? All right, and strategy number 3 for the seller credit tip is to actually negotiate these after the inspection. So whenever you're buying a home, you have the option of doing an inspection, which is where you'll have an idea of the home's condition. It's up to you guys, but it's very, very recommended because once you get that report back, which is usually a lengthy report, the home's not going to be perfect, right? Most homes are 50, 80, 90 years old, so they're not going to be perfect. And you're going to be like, hey, the roof needs fixing. That's going to be $10,000. Can you fix it? Or can you give us a $10,000, $20,000 seller credit, right? And your real estate agent, again, is going to negotiate this for you. So very important that you work with a great real estate agent. But this is another strategy that you can use in order to get more seller credits. All right, number 2 involves your credit score. Now, before we go into the 2 strategies, it's very important that you know that the bank will use the middle of your 3 FICO scores, right? We have Experian, we have Equifax, and we have TransUnion. The bank will use the middle score. So let's say your middle score is 720, then that's the one they're going to use on the application. Now, what happens if there's more than one person on the application? Well, in that case, the bank will take the lowest of the middles. So if your middle score is 720 and your partner's middle score is 650, they're going to use the 650. So very important that you know that and everyone's on the same page. All right, so now let's hop into the strategies for this credit score. Number one is, of course, having the highest credit score possible. One of the things that influences your interest rate the most is actually your credit score, especially when it comes to non-QM programs. These are non-traditional programs like bank statement, ITIN, in some cases jumbo, etc. Their interest rates are very, very, very sensitive to your credit score. Now, of course, they also help a lot when you're getting a traditional loan like FHA, conventional, and VA. So that's the first strategy I have for you guys, is have the highest credit score possible. I would recommend above a 760 in order to get a great interest rate. The second strategy involving your credit score is in order to get more affordable mortgage insurance with a conventional loan. So if you're getting a conventional loan, you're going to have mortgage insurance. What is mortgage insurance? Mortgage insurance is something you'll have under two circumstances. Number one is if you're getting an FHA loan. Number two is if you're getting a conventional loan and putting less than 20% down. Mortgage insurance is something that protects the bank in case you default. It does not protect the home, like home insurance, right? If your home catches on fire, it's not going to protect the home. That's home insurance. So mortgage insurance is different. And when you're getting a conventional loan, it's very, very sensitive to your FICO score. So on the screen here, I just have a general example of a $600,000 home with 5% down. One of them has the cost of a mortgage insurance with a 700 credit score, and the other one with a 780 credit score. Now you can see just by going from a 700 credit score to a 780, you get a savings of roughly $120 a month. All right, number three are lender credits. So that's where the bank will give you an interest rate above market in exchange for help with your closing costs. So let's say, for example, interest rates are at 5%. And the bank's like, hey, if you want a 5.25% or a 5.5%, we'll give you $2,000 for the 5.25, and we'll give you $5,000 for the 5.5 towards your closing costs. Now you're thinking, Enrique, why would I do that? I'm going to get a higher interest rate. Well, if you look at the numbers, in most cases, you'll get those $2,500 or those $5,000 for your closing costs with that higher rate, and your mortgage payment will only go up maybe $50, maybe $60. And in most cases, it's not too bad, right? You're getting $5,000 and your payment's only gonna go up $50 or $70 a month. I know I would take that, right? So very important that you ask your loan officer, hey, what do my numbers look like if I get a lender credit of 0.5% or 1% or whatever, right? This way you can come in with less money for your home purchase, and your mortgage payment will only go up maybe $50, $80, maybe $100 a month, but you got $5,000 or maybe even $10,000 for your closing costs. All right, number four, let's talk down payment. You don't need to put 20% down to buy your first home. So many people believe that they need to put 20% down, 30% down to buy your first home, but you don't need to do that. If you're a first-time home buyer, you can come in with as little as 3 to 3.5% down. And in most cases, even if you do have the 20%, I wouldn't recommend it for the following reasons. For example, let's say you're buying a $600,000 home and you want to go conventional and you want to put 5% down, which is what I would recommend if you're going conventional. Now, your down payment here, it's going to be about $12,000. Now, of course, that doesn't include your closing costs, but we're using basic numbers. $12,000 is going to be your down payment. If you put 20%, it's going to be $120,000. Now, here's a crazy thing, I'll have the numbers on the screen. The interest rate in this case didn't even change, which you're thinking, hey, I put 20% down. Shouldn't the interest rate go down? In most cases, it doesn't. And you're only saving $797 a month. Or you're thinking, Enrique, that's a lot of money. $800 a month is a lot of money. But guys, you put $120,000 down to save $800. I don't know about you, but I personally would rather keep those, $100,000 in my bank account and pay an extra $800 a month than put $120,000 into the home. So hopefully that's making sense for you guys. I'll have the numbers on the screen. But yeah, on one option, you're putting $12,000. On the other, you're putting $120,000. And in putting $120,000, you're only saving $800 a month. All right, number 5 involves property tax impound schedules. So when you buy a home, a little piggy bank is set up where it collects monthly payments for your property taxes so that when they're due to the state, they can go ahead and send them out, just to keep it simple. And depending on what time of the year you buy, on what month, escrow will collect a different amount of property taxes for your piggy bank, right? Now, what's really cool is that if you're buying in February, for example, in California, you'll only be required to pay 1 month of property taxes in your closing costs, which, let's say you're buying a $600,000 home, about 1.25% of that is the taxes, that's an average. And then if you divide that number by 12 months, that's $625. So on your closing costs, you'll just pay $625 for your property taxes. Whereas if you buy a home in October, which is one of the highest months in California, you're required to pay 9 months of property taxes if you're buying that month, which is roughly $5,625,000. So one thing you can do is go on Google and put your state and then put property tax impound schedule, and it'll tell you how many months of taxes will be collected depending on what month you buy your home. So it's a cool little tip to save you a few $1,000s if you want to save the most money on your home purchase. So that's pretty much it for today's video. If you enjoyed it, share with your family, comment down below what you guys thought, and I'll see you in the next one. Be great.